Welcome back to the Deep Dive. Today we're looking at, well, a really striking timeline. A prediction and then, boom, government policy. Makes you wonder, right? Was it just great foresight or maybe a deliberate nudge?
It really is fascinating. We're talking about this collision, advanced blockchain tech meeting high-level U.S. finance policy. And it all centers on this idea they're calling KYG, Know Your Government.
Okay, KYG, let's unpack that. So the starting point is Marshall Hayner, CEO of Metallicus.
Yeah.
February 5th, 2025, he puts this post out on X.
Yeah, pretty specific.
Right. He says, it's time to put the U.S. Treasury on-chain with KYG. Know Your Government. All expenses tracked real-time, unalterable, and fully transparent to the public. Each government office having their own verified digital identity that can be held accountable via the United States DAO. Quite a statement.
It is. And the really eyebrow-raising part, the speed, just 7 weeks later, March 25th, 2025,
Yeah.
the White House drops an executive order.
Exactly. Titled, Modernizing Payments to and from America's Bank Account. I mean, that timing it's something else.
It definitely got the industry talking. What's the shot called?
That's what we're digging into. We need to understand this KYG framework, what it actually means. And look at the tech stack that was apparently waiting in the wings for this. And what does it all mean for you, the taxpayer?
Yeah, we need to explore the policy background first. How could this prediction land so accurately? Then the tech itself, the architecture. And finally, what does this accountability model actually do?
Let's start with the person, Marshall Hayner. Sources often call him the Steve Jobs of crypto, but maybe more importantly, he's not just about the tech hype, is he? He's been in the policy trenches.
That's the crucial context. He's been doing this for over a decade, right? Working where the code meets the regulations since 2009, the early Bitcoin days.
Wow. Okay, so he understands the government side, the slow, careful pace.
Exactly. He gets the compliance mindset, the risk aversion. That's key insight.
And he wasn't just following rules, he was helping write them. Sources mention his legislative work.
Specifically, co-drafting the 2020 Cryptocurrency Act. That's significant because it wasn't just theory. It defined things, set up compliance paths.
Right.
And that work, it influenced later bills, things like the Genius Act, the Clarity Act. So when he made that prediction, it wasn't out of the blue.
Right, he was talking about a future he'd actively worked to make possible, technologically and legally.
Precisely. So the question becomes less, did he predict it? And more, did he help build the stage for it?
Which suggests this specific tech stack, the Metallicus one, wasn't just adapted for regulation.
Yeah.
It was designed for it.
That's the argument. Built for regulatory compatibility, not as an add-on, which, tackles the biggest hurdle for big institutions.
Right.
Legal risk.
Okay, that makes sense. It tees up the technology perfectly. So let's get into that architecture. You called it compliance first, designed for serious players like the Treasury.
Right. And compliance first means it's engineered to solve regulatory problems up front. It's not just about speed or features. It's about meeting the rules. For example, it handles things like OCC interpretive letters.
Hold on, OCC interpretive letters. Break that down. What does satisfying those mean for, say, a community bank?
It basically means getting a green light from a major bank regulator, the Office of the Controller of the Currency. If the tech already meets their guidelines for handling digital assets, well, that removes a massive layer of fear for a bank.
Got it. Legal clarity.
Exactly. It lets institutions, like credit unions, issue their own stablecoins that are already compliant. They can jump in without worrying about getting slapped down later.
And these smaller banks, they need the tools, right? Sources mention white-labeled banking apps, so they get the tech under their own brand with less risk.
Yeah, it lowers the barrier significantly. And critically, it's built for the global stage, too. It meets standards like ISO 2022.
ISO 2022, that's the big one for international payments, right?
Yeah.
Messaging standard.
That's the one. Used by central banks everywhere. It means payments carry rich structured data, not just send X dollars, but why, who, when, all embedded, essential for things like audits and stopping fraud, especially for government-level stuff.
So the plumbing is robust, it's compliant, but wait. If the Treasury uses this, isn't it just a private blockchain? Where's the decentralization aspect we always hear about?
That's a really good question. It's addressed through a kind of a layered approach. The base layer, metal blockchains, layer 0, that's the immutable public record.
Okay.
But institutions like the Treasury or a specific bank, they operate on what are called A-chain subnets. Think of them as dedicated permission zones on top of the base layer.
So they control who gets in, meaning their security and legal needs.
Right, but the actual transaction records, the proof, gets anchored back to that unchangeable public base layer.
So it's like controlled access, but public verification.
You got it. Kind of the best of both worlds for institutions. It allows them to plug directly into the existing payment systems, ACH, FedNow, the Fed itself. It's designed for that integration.
An institutional ecosystem built on layers with things like web auth authentication for secure identity. Makes sense.
Yeah, it's a comprehensive stack.
Okay, so we've got the architect with the policy background, the tech stack built for compliance. Now, the big why, this know your government idea, you said the executive order isn't just faster payments. It's about trust, accountability.
Exactly. It flips the usual KYC, know your customer, on its head. It's about verifying the government's actions.
So how does that work? Define KYG for us, especially that bit about a DAO-style model for the U.S. Treasury. That sounds ambitious.
It is ambitious, but it's about specific features. Think of it in pillars. Pillar 1, public auditing. Every tax dollar spent, visible. in real time, on the chain.
Wow. So no more waiting years for an audit report on, say, disaster relief spending.
Potentially, yes. You could see where the money goes instantly. That helps enforce Pillar 2. Verified identity.
Meaning?
Every government agency, every official authorizing a payment has a secure, verified digital ID on the blockchain. You know who spent the money. No more hiding behind bureaucracy.
Okay, real-time visibility, verified actors.
Yeah.
What about the DAO part, the accountability model? How do you get DAO-like checks and balances on government spending?
It's not about turning Congress into token holders voting on everything. It's about embedding governance rules into the system itself. Programmatic controls.
Like what? Give me an example.
Okay, imagine using multi-signature wallets for major expenditures. A payment only goes through if it's approved by, say, signatures from Treasury, the Government Accountability Office, GAO, and maybe an independent oversight body, all recorded transparently.
Or maybe rules about reallocating funds.
Exactly. Maybe shifting large budget amounts requires a specific publicly auditable consensus mechanism recorded on-chain. It builds in hurdles against misuse, fraud, or waste.
So the technology itself becomes a check on power. You don't just have to trust officials. You can verify the transactions, follow the rules.
That's the core idea. It directly addresses that public demand for transparency and efficiency. The verification part is key.
Okay, this brings us to what happens next. That March 2025 executive order. Just the beginning, right? The sources seem to predict a cascade effect.
Yeah, if the Treasury adopts these rails, everyone who deals with the Treasury kind of has to follow, don't they? The prediction is that you'll see community banks, credit unions, they'll all start running their own compliance subnets on this network.
Keeping their local focus, but plugging into this faster compliance system.
That's the vision and the scale. We're potentially talking trillions in stablecoins settling near instantly on these rails. Instead of days, settlement finality in seconds, it's a fundamental shift in how institutional money moves.
Whole new era, potentially, where citizens move from just trusting to actually verifying government finance. And it sounds like the tech, built with compliance in mind by people who understood the policy landscape, was the key enabler.
It seems the system was ready and waiting for the policy moment.
So let's leave our listeners with this. If the biggest financial players, Treasury, the Fed, your local community bank, are operating on transparent, auditable systems, what does that really mean for public oversight, for you?
Yeah, I mean, if you can see every dollar spent in near real time, how does that change politics? How does it change spending decisions? And on the flip side, what are the implications of that constant total visibility for how government actually functions day to day? Is there a potential downside to that level of transparency?
That tension between radical openness and practical governance, that's definitely something to think about.
A lot to explore there.
Indeed. Thanks for joining us for this deep dive.
My pleasure.
See you next time.